You got the promotion last year. The income finally cleared the threshold. The bank approved the mortgage. The payment felt manageable. So you signed. The house felt like the right move. For a few months, nothing changed. Then a better opportunity appeared. Different company, more interesting work, slightly less pay. A year earlier, you would have taken it without hesitation. Now, the mortgage payment sat between you and that decision. Not the house, not the neighborhood, not the commute. The number that renewed on the same date every single month, regardless of what else was happening in your life. The promotion made the mortgage possible. The mortgage made the promotion mandatory. That is not a coincidence. That is how the system works. The mortgage made complete sense before it was signed. Renting felt like paying into nothing. Every month, money left the account and disappeared. A mortgage was structurally different. The same monthly payment would build equity over time. The property would appreciate. Eventually, it would be owned outright. The math supported it. The culture reinforced it. Every financial article, every family conversation, every comparison between renting and buying pointed in the same direction. Ownership was the responsible move. So the paperwork was signed, the keys were collected, the payment began, and for the first several months, nothing felt different. The payment was manageable, the house felt stable, life continued normally. What did not get reviewed at the closing table was what that fixed monthly number would quietly do to every decision that came after it. Not immediately, not dramatically, gradually, 1 month at a time. The belief around homeownership runs deeper than finance. It is cultural infrastructure. Buying a home is framed as the transition from instability to stability, from temporary to permanent, from renting someone else's asset to building your own. That framing is not accidental. It is reinforced at every level. Schools teach it. Parents repeat it. Banks build entire product lines around it. The 30-year mortgage exists because it makes ownership accessible to people who cannot pay the full price up front. The monthly payment replaces the lump sum, and the payment is designed to feel manageable, small enough to fit inside a budget, large enough to require consistent income to service. The belief that forms around this is logical on the surface. A mortgage is an investment. The payment builds something. Renting builds nothing. That belief made the decision feel responsible. What it did not account for was what happens when a payment that requires consistent income becomes the organizing principle of every career decision that follows. The house felt like an asset. The obligation attached to it was harder to see. The mortgage system did not expand because home ownership was universally beneficial. It expanded because it solved a structural problem for multiple institutions simultaneously. Banks needed long-term, predictable income streams. A 30-year mortgage delivers exactly that. The interest front-loads payments, so the bank collects the majority of its return in the first decade. The borrower spends years paying interest before meaningfully reducing the principal. That structure is not accidental. It is mathematically engineered. Governments supported it because homeowners are statistically more stable. They do not relocate as easily. They invest in local infrastructure. They participate in community systems. Stability at the individual level produces predictability at the civic level. Employers benefited too. An employee with large fixed monthly obligations is an employee that cannot easily walk away. Mortgage payments create income dependency. Income dependency increases workplace compliance. An employee with a mortgage and a family absorbs more friction before resigning than one without fixed obligations. None of these incentives were ever explained at the closing table. The paperwork described the interest rate. It did not describe the behavioral architecture being constructed around the borrower at the moment of signing. The trade-off was never listed in the mortgage documents. It was embedded in the structure of the obligation itself. Before the mortgage, income had flexibility. A job could be left. A lower-paying opportunity could be taken. A career pivot could be attempted. The consequences of those decisions were temporary and recoverable. After the mortgage, every one of those decisions runs through the same filter first. Can the payment still be made? That question restructures risk tolerance at a fundamental level. It is not that the mortgage prevents decisions, it is that it raises the cost of every decision that threatens income continuity. A job change that would have felt exciting now feels dangerous. A business idea that would have felt worth attempting now requires a longer calculation. A bad work environment that would have been exited now gets tolerated longer. The mortgage did not remove options, it repriced them. And the repricing happens quietly, automatically, without announcement. The house sits in the neighborhood looking exactly like stability. The obligation attached to it reshapes behavior in ways that never appear in any financial disclosure. What was exchanged at the closing table was not just a down payment, it was a degree of income flexibility that most people do not realize they had until the moment a decision reveals it is gone. The constraint operates through a specific psychological mechanism. It does not announce itself. It embeds into the decision-making process so gradually that most people never identify it as an external force. They experience it as personal caution, reasonable risk management, mature financial thinking. But the caution is not coming from inside. It's coming from the obligation. The mortgage payment creates what behavioralists call a loss frame. Every career decision gets evaluated not by what could be gained, but by what could be lost. The payment that must be made, the income that must be protected, the stability that must be maintained. Decisions that once felt like opportunities now feel like threats. The promotion that used to feel optional now feels necessary. The difficult manager who used to be worth confronting now gets avoided. The industry shift that used to feel possible now gets postponed indefinitely. Each of these is not a dramatic choice. Each one is a small recalibration, a quiet narrowing of what feels available. And because each recalibration feels rational in the moment, the cumulative effect never gets examined. 10 years into a mortgage, many people are doing work they wouldn't have chosen freely, for employers they wouldn't have tolerated, at a pace they wouldn't have sustained, not because they made bad decisions, but because each individual decision was filtered through the same fixed obligation that renewed without interruption every single month. The compression becomes measurable when opportunity appears, not hypothetical opportunity, real opportunity. A recruiter calls with a role that pays 15% less but offers genuine autonomy. A business idea develops that would require 6 months of reduced income to test. A health situation emerges that would benefit from a less demanding work schedule. In each of these moments, the mortgage does not send a letter, it does not make a phone call, it simply renews. Same amount, same date, regardless of circumstances. And the person on the other side of that renewal does the math, the gap between the new income and the fixed payment, the months of savings that would cover the difference, the risk that the savings don't last long enough. The calculation is completely logical, given the structure of the obligation, but the conclusion it produces is always the same. Stay, absorb the friction, protect the payment. The recruiter gets a polite decline. The business idea gets added to a list that never gets acted on. The health situation gets managed around the work schedule rather than the other way around. This is optionality compression in its most concrete form. Not the absence of choices, the presence of a fixed obligation large enough to make every alternative feel unaffordable. The mortgage does not chain the body to the house, it chains the income to the payment. An income chained to a payment cannot simultaneously fund a different life. The payment will renew next month, and the month after that, for however many years remain on the document that was signed at the closing table. The opportunity that appeared last week will not wait that long. Neither will the next one. The house is not the trap. The need to protect it is.